Hello, everyone. I'm Kerry Lutz, and with Bell Powers, this is a production of Mining Stock Educators. Joining us today is Heye Daun, President, CEO of Osino Resources. Heye is born and raised Namibian mining engineer whose record clearly speaks for itself. And I've known Heye for several years now. I feel he truly embodies all the elements of a modern, successful mining executive. And with that, Heye, thanks for joining us. This is a big day for you and Osino today with the release of the pre-feasibility study results for the Twin Hills Gold Project, and we're all looking forward to learning more about it.
Great, thank you for having me on the show, Kerry. It's great to be back. So I guess I will get straight into the presentation and give you a bit of an overview of what went on today. I know it's a very dense press release that we put out, 30 pages out. You probably haven't had a chance to read it in detail yet, so I'll put it into context here. Of course, as we have guided in the past, the pre-feasibility, or we internally calling it the expanded pre-feasibility, was intended to put us into a different league. And by that I mean the production rate and the scale and the scope of the project. I think to achieve that, we'll see that we're putting on the book 200,000 ounces of production for the first 4 years, coming down thereafter, but I think we will backfill that in the future. It did come at a cost. The capital cost is quite a lot higher, but there are good reasons for it and bad reasons for it, inflationary, etc., and I'll go through that. So I understand that most of your listeners know the company, so I'll give you a brief background and then try and get some more detail on the pre-feasibility study itself. This is a new presentation. You'll find it on the website. In fact, we loaded it up probably an hour ago. We've got a lot of additional slides that deal specifically with the pre-feas, and we continue to sort of polish this presentation in the next couple of days and might update that. So in summary, Twin Hills is a high quality, low cost, long life development asset. I believe what really sets it apart is that it's one of the cleanest, in inverted commas, advanced development or pre-construction stories out there. What I mean by cleanest is it's got no issues. It's got no boiling water, no ice or Arctic conditions. It's got no tropical rainforest. It's in a vanilla location, Namibia, very mining friendly, very predictable, and a very easy place to operate in. We have great shareholders that continue to support us. Some of them have been selling lately. I guess you've seen that, but that's just the market. But on all, a very, very supportive shareholder base. And we now have a very real project that is increasingly de-risked and it continues to be fast-tracked into construction. So I'll scan over these Namibia slides. Of course, I've spoken about that in the past. We are bulking up the team, so we've added a couple of new members, in particular a project director. He's been with us for a while, but he's becoming full-time now, and he's been instrumental in delivering this high-quality pre-feasibility study, and he's also helping me to build a true execution capability, because of course, once we get to the end of the study phase, we're going to have the ability to actually implement this project ourselves, and so a lot of work is going into that at the moment. Just very briefly on the share structure. So a couple of things that have changed. So we added B2Gold to the share register. As you might remember, we did a deal with them on one of their non-core projects. So they own about 8% of us now. You can look at the share price performance there relative to a junior index. Unfortunately, we haven't outperformed. In fact, we've underperformed lately. And that has been largely because of developers having generally underperformed the market, but also some unique selling, which I've spoken about publicly in other fora, where one of our significant shareholders, not RosBT, not RCF, another one, has been doing a lot of selling of our shares. So, but I think we're getting through that. So fast tracking here or going forward to the pre-feasibility. So as you know, this a lot of your listeners would have seen the slide before. We have this is the drilling that we did that resulted in the resource that we put out a little while ago, 3 million ounces. What I need to emphasize here is that we have within those 3 million ounces of inferred and indicated, we have a high-grade component of 2 million ounces at almost 1.5 grams per ton at a cutoff of 0.9. So that's very significant, because I think one of the issues is that some people see the Twin Hills project as as somewhat low grade, which it is. It is somewhat low grade, but it does have the opportunity to improve that through blending and cut-off grade optimization. So let's get into the pre-feasibility study itself. So maybe just a high-level update on the key numbers. So using a gold price of $1,700 per ounce, we have an after-tax NPV of about 500 million US dollars. It's got credible and good economics. So after-tax IRR of 26%. Payback period is about 2.3 years. Sorry. Yes, the development capital is quite a bit higher than I've even previously guided. I previously kind of indicated it would be in the $320 million range. The reason for that increase, there are a couple of reasons for that. Firstly, it's a much bigger scope. You know, the project size has gone up by roughly almost 50%. So that has resulted in obviously a bigger capital need. There have been very significant inflationary escalations. So this study is an honest study. It is also a very recent study. So the inflationary numbers that everybody talks about are reflected in the study, and that's different to, I think, a lot of the older studies that are out there that people compare us to. We've also improved our estimate generally. So there are a couple of things that we had previously underestimated, things like the infrastructure, the general infrastructure, the tailings facility. In this case in particular, we opted for a dry stack, double-lined tailings facility, which is really the right thing to do. It's a Mercedes-Benz. It does have a benefit in that it has a much lower water consumption, and obviously it has major environmental benefits. And I think with the increasing focus on doing the right thing, we had to opt this way, but it came at a cost of about 50 million US dollars. So that was a significant contributor. And then also we added some additional nice to haves which improve the overall project. Things like $20 million for a solar plant, which reduces our power costs, and $20 million for pre-stripping, which was necessary to achieve the much higher production rate of 200,000 ounces per year. So these are all, in inverted commas, good capital items that have improved the overall project. But of course, that is one of the numbers that that people are focusing on, which has been a slight disappointment. I think a very important metric, which I'm very proud about, is the reserve of 2.15 million ounces coming out of a resource of around 3 million ounces. So a very high, in fact, an industry-leading conversion of resources to reserves, leading to total life of mine gold production of about 2 million ounces. That really puts us in a different league. It puts us into the league of the ore zones, Marathon, sort of those kind of companies that are kept at a couple of $100 million, $300 to $500 million. That's where we wanted to be. The market hasn't woken up to the fact that that's where we are. But I think as we promote and as we spread the word on the success that we've had with this pre-feasibility study, I do expect that the market will catch up to that. The average annual production rate over 10 years there is 170,000 ounces. So that's obviously the life of mine is a little bit longer, but at the tail end of the life of mine, the production rate is quite low. So I've excluded it from that average. But it is a production rate of, on average, of way north of 150,000 ounces. So it's basically a 50% improvement in production rate since the PEA. That was really the objective of this entire expanded pre-feasibility exercise. The costs, the cash costs, they're $830 an ounce. That's very respectable. And even on an all-in sustaining basis, $940 an ounce. It's in the footnote there. We are still in the middle or in the lower half of the sort of, I guess, in the upper end of the lower half of the cost curve. So not a bad place to be. Very strong margins. And even at a stressed gold price of 1,400 and a high discount rate, whatever the sensitivity analysis in the press release, the project still delivers a positive NPV. So this is a robust, real project that's going to get built quickly. You can see there the first 5 years, very good head grade of just about 1.5 grams per ton. So this is a busy slide. You can look at it yourself on the website when you open the presentation. I guess this diagram here summarizes that summarizes the cash flows and everything overall. So you can see cumulative cash flow on this graph. You can see the mining costs there, the blue, that's the biggest contributor of total costs, processing costs, capital upfront, initially higher cash flows of between 150 and $200 million per year. That's where the 2.3 year paper comes from. So these are very robust economic numbers, and these numbers will enable us to raise the debt required to build this project, and overall a 13-year life of mine, as you can see over here. So a very credible result for a project, as I say, that's going to get built. The reserves and the resources, I'm not going to get into the resources too much. I've mentioned the number earlier, and there's the 2.15 million ounces in reserves at a diluted grade of 1.04. I think there's scope for that grade to improve going forward as we drill more of the high grade shoots, which we've intercepted in the last couple of months. So this is the hot off the press site layout. It's much improved from what we did in the PEA. Of course, as we go from a PEA to pre-feasibility study, the level of detail that goes into the assessment and the engineering and so forth is reflected in this. We have 4 pits, call it 3 real pits. Clouds over there, that's a high grade pit, comes at slightly lower recoveries, about 89%. And then Bulge and Twin Hills Central, which is the main contributor, about 92% recovery. And then Twin Hills West, that was a new discovery that we made at the end of last year, and we drilled in the first half of this year, and it's contributing meaningful ounces. We also have this is a little surprise there, that little pimple at Clouds West. It's a high grade zone that I think will continue to grow. So this is truly a kind of a string of pearls, and I think that as we drill more, we will discover more, and even these blue pits here will continue to grow. You can see the dry stack tailings facility over here. The beauty of a dry stack facility is not only the environmental benefits, but also it can be built on a modular basis. So some of that capex is laid off and is reflected in the sustaining capital that you see in our financial analysis. So this is what the process plant will look like. This is also very hot off the press. This is what this animal will look like for those of you, for those of the listeners here that are not familiar with mining projects. It's basically a straightforward circuit layout with 3-stage crushing. You can see down there, primary crusher, secondary crusher, tertiary crusher, with an HPGR. It's in a high pressure grinding rolls. It's not new tech. It's been used at other mines before. It's an energy efficient way of breaking the rock down to the fine grind that's required. Like a Tropicana mine in Australia is a great comparative. That's an Anglo Gold mine that have the circuit, and actually the Otjikoto circuit in Namibia is very similar, except it does not have an HPGR. And then there's a ball mill and a gravity circuit. We have about 30% gravity recovery, and then straightforward CIL leaching, and will produce doré bars. So the beauty of having done this work to this level of detail is, of course, that the scope and the costs and the timeline of delivering this project is now defined, and it enables us to move into the next phase, project financing and so forth. So the production metrics, again, it's a busy slide. I'm not going to go through it now. I've mentioned most of these numbers. You can look at that on the website when you go there. So the development timeline, I guess this is, of course, a very important question. Where to from here, and where are we now, and where do we go from here? So I think the easiest way to conceptualize this is to look at the sort of 4 phases of project development and project implementation. The initial phase was the exploration phase, which we were in last year and parts of this year. That culminated in the various resource updates that we put out. We then got into the study phase, which was most of what we did in 2022, which culminated in this pre-feasibility study that we're putting out now. During this phase, also, we are working on securing the key permits, mining and environmental, which I believe are imminent. In the next few months, we should be getting them. And that will enable us also in this phase to push forward to receive project finance term sheets. Obviously, we're a small company with a low market cap, and the big question in everyone's minds is how are we going to raise the debt and the equity to build this project. So this phase will take us to about the first quarter of next year, and will end with the delivery of the definitive feasibility study. That definitive study is one of the key requirements that the drawdown of project finance will be subject to. Most of the work going into that has actually been completed. We've been very proactive in doing this. And so we're highly confident that in the next 6 to 9 months, so certainly in the first half of next year, hopefully by the end of the first quarter next year, that will be completed. And then from there, you enter what some people will call the FEED phase, front-end engineering and design. That's where you convert the pre-feasibility study into detailed drawings. You start ordering the long lead items, you hire your mine building team, and then at the end of that FEED phase, which is typically a 6-month process, you would start construction. So I think reasonably, you can expect that early works and construction would commence in the second half of next year. That's of course subject to project financing and subject to getting the final permits and that definitive study. But I think most of these items are well within our control, and that's what we're going to focus on in the next 6 months. In addition to that, just to add on at the bottom, Ondundu, some people have, are aware of this project. We don't talk much about it, although it is a very important cherry on top of the cake. That's a project that we acquired from B2Gold. We closed that deal a month or two ago. It has been drilled extensively by B2. They've drilled about 40,000 to almost 50,000 meters. They did very high quality technical work, but it didn't fit into their long-term plans, so they sold it to us. We intend to put out the maiden resource on that project later this month. In fact, in the next few weeks. I think that's a game-changing news release because it's going to bulk up our total resource inventory very substantially, and it is tangible future growth for Twin Hills to both backfill our declining production profile in the later years, and also to deliver additional growth in existing to the exploration that we're going to carry out over the next few months. So that's the site layout. Most people would have seen this slide before. The yellow highlighted area or yellow dotted area are the two pieces of the farms, what we call it in Namibia, or the ranches that we are in the process of acquiring. I think we will close these transactions also later this year. And that's a major de-risking event for the project as a whole, because then, of course, owning the surface rights gives us basically just about absolute control over the delivery of this project. So we're very excited about that. The terms have been largely locked on, and we're waiting for some final government approvals to conclude this process. The early works that would take place would be a relocating or a construction of a new road. It's a short section, probably about 5 or 8 kilometers, that's indicated in orange here. And that's probably early works. And then, of course, the short tie-ins, grid power, water supply, some additional walls, etc. So this is all very easy, and that's the first sort of earthworks that we would carry out or enter into once the project financing is secured in the first half of next year. Other than that, the site layout is straightforward. It truly is vanilla. We're very close. We literally are on one of the main roads in Namibia, a surfaced perfect road going up to the north, one of the national roads. We've got we're about 14 kilometers from a well-established mining town. So very good infrastructure in place, really a unbelievable location for a project. So very happy about that. In terms of ongoing studies, of course, we're still working with a high-class group of consultants that is still working away. We're not resting on our laurels. In fact, we have already started the definitive feasibility process. We've got a very tight timeline to deliver that definitive by Q1 next year. So all the other consultants that you can see here are very active on that at the moment. And then lastly, I've got a couple of slides here just to benchmark the project to the relevant peer group. Reminding you, I think one of the problems that Osino has had in the past is that we've been thrown into or we've been seen to be part of the sort of advanced exploration PEA bucket, because that's where we were. But of course, we beavered it away quietly in the background, and that's now culminated in the publication of this pre-feasibility study, which is benchmarking us at a much higher level, a much more unique and much more rare level of comparatives. So I've got some of these names here, I've mentioned them before. For example, Marathon in Newfoundland, very similar scale of project, slightly higher grade than us. Yes, they're in Canada, slightly smaller reserve, although they lately added a few extra ounces there. So that's a very good comparative. G Mining Ventures is a very good comparative. Very similar project scope. They're in a more difficult location in the Brazilian rainforest, almost, or not quite rainforest, but in the Brazilian sort of hinterland. But yeah, very similar numbers. And then Tieto, that's an ASX listed company, actively building a mine in Ivory Coast. And there's Ozone, very similar to us, 2 years ahead of us, I guess. They're getting to the end of the construction of their mine. So these are the kind of comps that you can compare us to. Of course, as I mentioned earlier, the reserves, on a reserves basis, we're looking very good. You can see we're at the top of the list there. On a resources basis, we're a bit lower, but we've been very efficient in terms of converting those resources to reserves. But we are in this ballpark. On a valuation basis, we are at the bottom of the pack. So the most relevant valuation metric to use for a company at our stage of development is price per NAV. So that's the current market cap divided by the value of the project. And that puts us at a valuation of about, call it just under 0.2 times NAV. I can tell you that that is historically depressed. That's a historically depressed rating. Our peer group is generally trading at the 0.3 to 0.4 price per NAV, which is basically a double from where we are currently. So I think that would be a reasonable valuation in these depressed environments. Historically speaking, over 10 or 20 years, developers like ours would have been trading at more like 0.6, 0.7. So therefore, there's very substantial upside here and re-rating potential that usually comes with execution and delivery of these de-risking events that I spoke about earlier. So that's price per NAV. Of course, another multiple to look at is what's our value per ounce in the ground in terms of reserves. And there it's a similarly extreme valuation. I think a reasonable peer group median is sort of, call it $75 to $100 per ounce. Even historically for reserves, that's a good number. And we are trading at 1/3 of that at the moment. So I think these slides really highlight the mispricing or the valuation disconnect that's happening in the market right now. And I mean, one of the things I can talk about is that we've had a major seller that's been selling us over the last 3 weeks. For those of your listeners that have paid attention, our volumes have been very high over the last 3 weeks. We've eaten up most of that stock. We've been able to absorb most of that stock, but nevertheless, it's resulted in a big derating of our share price. Not just us, a lot of these comps here have derated similarly. But yeah, as I say, the share price is the share price, and nothing much we can do about it. What we can focus on is execution and delivering this project, and that's what is occupying my mind at most. And then there's some other metrics in there that you can look at in your own time in this press release, sort of benchmarking us against that peer group. And maybe that brings me to the end of the presentation. So even at stressed gold prices and assumptions, this project is still profitable. So I think we really have a high quality project here. It's a very real asset. It's one of the very few significant de-risking to occur over the next 6 months, and we will continue to fast track this. Just a word, obviously, on doing the right thing. That's very important to us. ESG, what the North Americans call ESG, we call it just doing the right thing or responsible mining. Done a huge amount of work there. And in the next few weeks, we will publish our maiden sustainability report that will sort of express on a lot of these things that I'm highlighting here. We've put a lot of effort into this, and we're a very responsible corporate citizen. We are a big fish in a small pond in Namibia, and this project is going to be truly transformative in terms of socioeconomic development in Namibia. So as a Namibian citizen, I'm very pleased that I can bring this and that I can ensure that proper custodianship is maintained and that this project gets built in the right fashion. So that brings me to the end of the presentation. Back to you, Bill.
Thank you, Heye. Please submit your questions in writing. We already have a number of them that I'll present to Heye, but if you could present them in writing via the feature, I believe it's on the right, you'll see that question submittal portal there, and we can present them to Heye. Heye, the first question we have is, where will be the focus for the next drill campaign?
So at the moment, we are not drilling. That's obviously, as you can imagine, we are in capital preservation mode. So therefore, we're not drilling at the moment. We will only start drilling again once we have raised additional financing. So we expect that to happen post Beaver Creek at some stage. It all depends on the market. Obviously, you can't predict when financing will happen. But I think at the moment we're scheduled to start up drilling again later in September or in early October. And that drilling will focus primarily on chasing some of the high-grade shoots, making Twin Hills better and bigger, some step outs, some additional grade control drilling, which enables us to do more aggressive resource modeling, which should help the grade. And then, of course, limited exploration drilling, because there is very substantial upside brownfields, but also in country. We have some exciting stuff going on, some exciting anomalies elsewhere in the company that the team is really raring to test. But for now, we've got to be cautious for the next few weeks and just lay a new foundation in terms of capital.
All right, next question. Is the biggest risk for the company currently project financing due to the depressed share price of Osino right now?
Yeah, so when you say risk, of course, what is risk? I mean, risk makes it sound so hairy and so bad. Risk effectively is uncertainty. So if you characterize it like that, yes, I agree. Project financing for a developer is always an uncertainty, but it's been done before. I mean, look at G Mining Ventures. They were a $150 million company. They raised $450 million recently through a combination of debt, equity, stream, the whole capital stack. And they're going to build that project. And I think that's a great comparison to us. That's what we're working towards. We've been fairly quiet on it. We've obviously been working in the background. We'll make some announcements soon. But now that the pre-feasibility is out and we've actually defined the scope of the project, now we can commence a proper debt beauty parade, let me call it that. And what I mean by beauty parade is we've already received expressions of interest from a number of high quality debt and royalty and alternative finance providers. These are like senior banks, credit funds, Osino, Franco-Nevada, these kind of companies. I'm not saying it's specifically them, but those kind of companies. And in the next 6 months, we will seek to convert those expressions of interest into firm term sheets. I expect to get term sheets from a select group of offerers by the end of this year. And we will then use the first quarter of next year to convert that into true credit approved offers of finance. So that's quite doable. That's within our control. And the interest that we have already gives me great confidence that we will be able to pull this together. The big question is, how much equity do we have to raise? I can't tell you the answer to that. One thing that is for sure, with these high early year production rates in the Twin Hills project, we have a high debt carrying capacity. And so I expect that probably 65 to 75% of the project finance will be financeable through debt, which leaves a gap to be filled. Of course, we would want the equity dilution to be as low as possible. So one of the trump cards that we have is potentially to raise a royalty. Royalty financing these days is very cost competitive. It's non-dilutive. So we certainly will be having those conversations. In fact, next week already, when I'm at Beaver Creek and Denver Gold, we deep into the weeds on this conversation.
All right, next question. What changes could we expect to see in the definitive feasibility study versus the PFS?
I don't know, because we haven't done it. I think, but I can give you a guide. I mean, the scope of the project is not going to change. We've locked that down. Most of the trade-off analyses have been done. That's what you do during a pre-feasibility study. I would really hope that we can bring the capital down a little bit, and there are some opportunities to do so, for example, through reversion to mean on some of these high commodity prices. Like I can tell you, transport costs, for example, we've got some extremely high transport costs and steel prices, etc., that are baked into this pre-feas capital estimate. And as of course, what happens in a definitive is that you do a much more detailed and robust estimate. So I do think that we will see some cost savings coming in. Other than that, I think the beauty of this pre-feas is it's a very honest pre-feas, so I don't expect any major changes. I hope that there will be some slight improvements, some marginal improvements on the capital numbers. Also, remember that the pre-feas has quite a high margin of error. So it's like plus or minus 25%, I believe. That's what the engineers do. I believe ours is better. But as you move into a definitive, it will go to probably sort of plus or minus 10, 15%. So yeah, I think the definitive will give better definition, but probably more of the same, not a major change. And that's a good thing.
Is management and insiders out of the blackout period, and can you buy your own stock in the open market now?
Unfortunately, I can't answer that because the lawyers are busy trying to figure that out as I speak. I mentioned we do have the Ondundu resource estimate, which is supposed to come out imminently, and we're trying to figure out to what extent that could stop us from buying. And we have another couple of bits and pieces, but I can't really say. I can say that we are rearing to go. We really want to buy stock, and we will do so as soon as we can.
Okay. Is Navichab still of interest for Osino Resources?
Yes, it's of interest because it's right next to us, and there are a lot of synergies to be had. But it's not something that we can determine. The Navichab, there was a sort of a semi-confidential sales process underway, which got stopped. I believe that the shareholders of Navichab are busy rearranging their own sort of ownership affairs. So for now, it's off the radar screen. It's a nice sort of something over the horizon, but we focus on the Twin Hills project. We've got enough on our hands.
Is there a realistic path to produce over 200,000 gold ounces per year for the entirety of the mine life?
So I've got to be careful here because, of course, my answer to that is going to be speculative and conceptual because we currently do not have the mineral resources to do that. Otherwise, it would be reflected in the PFS. But my good engineering and geological judgment tells me that these things tend to grow. The best example is Navichab right next to us. Navichab was built on 1 million ounces. It's produced 2, and it still has 4 or 5 million ounces left. So I have very high conviction that Twin Hills will continue to grow. In a year or two, it's going to be 3.5 or 4 million ounces, and I think those ounces will backfill that production profile. So I do think that Twin Hills will become a 200,000 ounce producer for the life of mine, but that's of course speculative. And I mean, another good example is if you look at Otjikoto, the B2 Gold mine was built on a feasibility study of, I think it was around about 150,000 ounces a year, 130 to 150,000 ounces a year, and they have consistently produced 170 to 200,000 ounces a year. So these things tend to get better as they get more defined. So yes, I'm hoping that we will backfill those production rates in the later years of the life of mine. And we're certainly working.
And would one source of gold come from Ondundu, possibly?
Yes, absolutely. So that's why with Ondundu, the plan is to get the maiden resource out ASAP. I believe it's going to be sometime in the second half of September. And then to follow that up as soon as possible thereafter with a PEA. Most of the work, the test work, that's what takes a long time, has been done. In fact, we did metallurgical test work to prove up the gravity concentration technique that we want to employ there, and it looks good. It's going to take us probably 6 months or at least to do a PEA on Ondundu, but once we have that, we could then formally add those extra ounces to the sort of production profile, even though it's only at the PEA stage. So obviously we'll disclaim that, but yes, for sure, Ondundu is a real cherry that we're looking to quickly bring into our production profile.
Hi, I think you did address this, but we have a listener that asked, can you please highlight the status of the surface rights? Is there anything more you could elaborate on?
Not really. I mean, we're on good terms. We know where it's heading. We're waiting for some approvals from government, and that's the complication really is that land ownership in Namibia, agricultural land ownership in Namibia, to foreigners is sensitive because of the history of the country, the sort of apartheid history. So therefore, in order for a foreign company to own agricultural land in Namibia, which this is, you have to have a range of approvals, and they unfortunately took a very long time. Of the 4 approvals required, 3 are done. So I think we are around the corner. So I think in sort of October roundabout, hopefully we'll be able to announce that deal. But I think we're just in front of the finish line.
All right, two more questions. There was an Air Force base right by your gold deposit. Is that an asset or a liability?
It is when you say it, well, the short answer is it's an asset and a liability. It's an asset because we've got there's a military base there which gives us protection. It's an asset that we could potentially use for gold transportation and other things. So we have a very good relationship with them. The liability is that because they being a little bit sensitive about no-fly zones in the area, that's why for exploration it's a bit of a liability because it makes it difficult for us to fly magnetic surveys and other things. But we do have a good relationship with them. Bear in mind that yes, it's an Air Force base, but there are no planes there, or there are only a few. So the Namibian Air Force is not that well equipped and it's not that active, and so it's not a very active Air Force base, I should say. But we've got great relationships with all our neighbors, including that Air Force base, so no problem.
What is the percentage of management holding of Osino Resources?
I don't have the exact number because like Alan Friedman and I and some others, we hold our stock in different accounts. But altogether, I believe my holding together, if we add it all up, it's probably about 10-12%. And that includes our associates and close family. Like my father is a significant investor, my brother, my sister, Alan Friedman's family. So if you include that sort of group of family, I think we're sitting at about 10-12%.
Okay. And you did cover this, but this will be the last question, Heye. How long would it take to permit and bring into production, assuming it's financeable? If you could just review that one more time, please.
Yeah, no problem. So the permitting in Namibia is doable and is soon for us, soon will be predictable because we have reason to believe that we will get the mining permit soon and the environmental authorization too. Once we have that, then the remaining permitting is entirely predictable because then it's a mechanical process of getting those site-specific permits. So I think it's fair to assume that before the end of this year, we will have the mining permit and the environmental authorization. That's the key ones. Then in conjunction with the engineering and design phase and construction phase, we will get all those site-specific permits. So permitting in the bag. The construction period will take 2 years. It's a big plant, so a little bit longer than I said before, 2 to 2.5 years at most. And before, let's call it 2 years construction and 6 months of FEED, front-end engineering design before construction. So let's say our FEED starts in the first quarter, will take us into the third quarter. Let's say early works construction commencing in the second half, early in the second half. If you then fast forward 2 years, so that's 2023, 2024, 2025. I think it's probable that we will have gold production in the first half of 2025. Hope that makes sense.
Excellent. Well, Heye, thank you for this presentation. Kerry, I will send it back over to you, please.
All right. Thank you, Bill. Thank you, Heye. Very interesting, compelling presentation. It's obvious to me that with the release of the PFS, Osino is clearly at a crossroads, a highly positive crossroads. And also listening to your presentation, Heye, although I knew it already, it seems by virtually any measure, Osino is grossly undervalued. By historic levels, even more so. So I want to thank everybody for joining us. Heye, again, thank you for being here. If you want to watch the presentation again, or you missed part of it, or you want to pass it on to a friend, you will be getting a replay link within the next hour or two. And again, for more info and to view the presentation, go over to the company's website, osinoresources.com, and sign up for your notifications. The ticker symbols on the OTC, it's OSIIF, and on the TSXV, it's OSI. Heye, again, thank you. Bill, all, that's the end of the webinar. Thank you all for attending.
Thank you very much.